Alphabet is quickly catching Amazon in the cloud business. In this video, I'm going to talk about and compare Amazon's cloud business to Amazon's cloud business to demonstrate why it's so important for Alphabet stock investors. I'll also talk about a couple of other subjects, but primarily I'm going to focus on that comparison and why it's important for Alphabet investors. Let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So in its latest quarter, Alphabet said that revenue increased in the cloud segment by 30% to $12 billion in the fourth quarter, reflecting growth in Google Cloud partners across GCP products, AI infrastructure, and generative AI solutions. More importantly, Google Cloud operating income increased to $2.1 billion, and the operating margin increased from 9.4% to 17.5%. The operating margin almost doubled. And this has only been a few quarters now where Google Cloud operating income was positive. This is a business that Google has just recently built up in recent years, and it's now grown to a segment that's generating over $2 billion in quarterly income. That's vitally important. Now, compared to Amazon's cloud segment, in its latest quarter, Amazon's cloud revenue increased by 19% to $28.786 billion. So Amazon's cloud segment grew by 19%, where Alphabet grew by 30%. And it's been several consecutive quarters now that Alphabet's cloud segment is outperforming Amazon's cloud segment. Of course, it's smaller scale, right? Amazon is at close to $29 billion, where Alphabet was closer to $12 billion. Another interesting point is that Amazon's cloud segment revenue is accelerating in recent quarters. It was decelerating all the way down to 12%, and then it started jumping again to 13 to 17, and now 3 straight quarters of 19% growth. Also, if we look at profitability, you can see the operating profit margin of Amazon's cloud segment at 37%. And it's several straight quarters now where this segment generates above 30% operating margins. And the reason why that's good news for Alphabet is, remember I shared with you its recent operating margin in the cloud segment was 17.5%. This suggests that the trend line improvement is sustainable and it's likely to continue increasing if Alphabet can continue generating revenue growth near 30% for the cloud segment. So imagine the cloud segment, let's say, continues to grow at 30% for a few more quarters, and at the same time, the margins are expanding closer. Alphabet could get this business up to a point where it's generating annual revenues closer to $100 billion with operating margins closer to 30%. That can be $30 billion in operating income for its cloud segment, which would rival that for its most important segment, the Google service segment, which generated operating margins much higher than 30%. So that's why that's great news for Alphabet stock investors, is because the company's demonstrated substantial growth in this critical category, and its biggest rival, or the biggest rival, Amazon, is the leader in the category. It has operating margins north of 30%. And so Google Cloud can theoretically reach those levels at larger scale, which it is, in fact, approaching. If it generated $12 billion in the fourth quarter, you annualize that, it's almost $50 billion in revenue run rate, and the segment is growing. So that's great news for Alphabet stock investors. I mentioned I wanted to talk about a couple of more things in this video, and one of them was the overall capital return. The company returned over nearly $70 billion to shareholders in 2024. That's how much cash flow they generated, that they had $70 billion to return to shareholders. In fact, Alphabet, to be more precise, generated $125.3 billion in trailing 12-month cash flow from operations. This business is a cash generating machine, very lucrative business model, and it generates most of its revenue from asset light businesses that allows it to return significant sums of capital to shareholders, even though it's undertaking a massive capital expenditure program. In 2025, Alphabet expects to invest approximately $75 billion in capital expenditures, with approximately $17 billion happening in the first quarter. So despite the fact that they need $75 billion in 2025, they plan to spend $75 billion in 2025, they still returned $70 billion to investors. That's how much they have, that they said, look, we need to spend $75 billion this year, and investors hearing that said, oh, does that mean you're not going to give us back some money? And Alphabet said, no, we have so much that we're going to give you back 70 billion, and we're still going to spend 75 billion, and we're still going to have many, many billions more waiting in reserve just in case we need it. The business is just so phenomenal, generates so much cash flow, and investors were sort of freaking out when they heard this number, $75 billion of capital expenditure, because it was a 50% increase from the prior year. So they were a little bit concerned that, man, you're spending a lot of capital in 2025 and you spent a lot in 2024. What does that mean for the business? And Alphabet said, it just means that we found this great opportunity. We have all this cash. We're just excited that we found this opportunity. It's hard for a business of our size to find opportunities to put this much capital into. So we're grateful to have found this opportunity in AI. And so we're going to go ahead and capitalize on that by spending the 75 billion. And maybe next year we'll spend 100 billion if that opportunity remains. And we're excited about that because we don't really have anything else to do with the capital. It's either we're going to spend it on this or we're going to give it back to shareholders because we have too much money. We have more money than we know what to do with. And so when you're reaching that scale, that becomes a problem. That is one of the reasons why when companies grow this big, their growth rates decrease and they become a stagnant business. You don't want to see that. So you'd prefer to see the business finding opportunities to invest, because when you invest capital, it's with the intention that you're going to see the benefits of that in the years to come. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.